afternoon, everybody. It's Friday, April 28th. It's been almost a month since we did our weekly recap. I've been traveling, and here I am in sunny Dubai, but I didn't want to wait another week, even though, well, not a whole lot has happened, but there are many stories to talk about. When I say not a whole lot has happened, I'm talking about the market. So Bitcoin over the last month, the last 4 weeks, is up 2%. Ethereum has had a bit more of a rally. It's up 5%. But during that period of time, there's been some substantive action. Bitcoin's made 3 different runs over 30,000 and 3 different attempts to pierce 27,000. And that's gotten a lot of interesting juices going. We've seen euphoria as it goes past 30 with people talking about new all-time highs imminently. We've seen despondency when it goes down towards 27 that, the jig is up. All of this Bitcoin is going to get sold, and there's no support between here and 10,000. We've heard all of that. Ether has been a bit stronger, mostly because, as we talked about over a month ago, the Shanghai upgrade allows people now to stake without the indeterminate lockup of their stake coins, meaning that there's been a net increase in staking, which makes enormous sense and is exactly what we thought would happen. But the reality is that the market tends to be over exuberant in one direction, over despondent in the other. And a large part of this has to do with the narratives that are going on. So there's 2 main narratives that are happening in the crypto markets, particularly here, or particularly in the United States, where CoinRoutes is based. So narrative number 1 is the Federal Reserve. Narrative number 2 is the SEC and regulation writ large. Well, let's talk about each. The Federal Reserve is set for next week, to probably, according to 92% at press time, raise rates another 25 basis points, and then likely in their conversation say they're going to pause to watch what indicators are doing. Now, this is sort of what people are expecting, but there are many economists who are just putting their heads in their hands, saying, I don't understand why they would raise rates again, considering that commodity prices in many cases are cratering, considering that most of the leading indicators of inflation are bottoming out in the United States, and considering that the stresses in the financial system, if anything, have gotten worse, and they could essentially be worsening the upcoming recession. So people in the world of crypto are saying, well, okay, that's likely, and that means when they do pause and they do ultimately pivot, the pivot will have to be harder. I don't know what will be the reaction to the reaction to the reaction. What I do know is this. We are getting toward the end of a tightening cycle. We are at rates that are hardly high from a historical perspective. If anything, they're in the bottom third of a long-term range if we exclude the zero interest rate environment that we've had recently. And effectively, there's no reason why rates of this magnitude should harm assets that are somewhat risk assets, except for the fact that if you're trading on multiples, if you're an equity, that are absolutely strained, then yeah, you would expect to see them get pushed. As a result, when we talked about this, I was on Scott Melker's Macro Monday podcast on this Monday with Mike McGlone from Bloomberg. My point is that, yeah, there could very well be a cratering in certain equity sectors, the ones that people value in discounted cash flow models and are now at very, very strained multiples. But things such as Bitcoin, which really is an asset that is mostly predicated upon a lack of confidence in government institutions, most notably the Fed and the government, which prints the currency, there's no reason for it to necessarily drop nearly as much, particularly if we're more or less toward the end of the heightening cycle. So we will see what happens. There are some catalysts that we'll talk about in a second. The other main narrative, before we talk about the economic catalysts, is the regulatory environment. And here, it's definitely worth discussing a couple of things. So over the last month, we've seen multiple SEC actions. We've seen multiple places capitulate, such as Bittrex leaving the states, and then after they said they were going to leave the states, the SEC sued them. We've seen a lot of companies talk about, such as Coinbase, locating and moving and opening up exchanges offshore, Gemini as well. We talked about the last time how Circle has already said they're going to move to Paris. But what we saw in April were 2 events that I think are quite key and bear absolutely watching. The first one had nothing to do with crypto. It was Axon versus, the Axon case in front of the Supreme Court, which was a 9-0 decision that effectively says that people who believe agencies are overstepping their bounds can sue the SEC or sue the FTC and can sue government agencies. So on the heels of that, Coinbase has launched a lawsuit to force the SEC to rule on their basic petition for rulemaking that they had made before. Now, this is an interesting case because it could mark the first defensive case the SEC has. We all know they've hired lots of enforcement attorneys, they've issued multiple Wells notices, and once again, in Coinbase's case, is another, they've made public their defense against that Wells notice. And effectively, the argument is very simple. It boils down to, do you need to have a clear regulatory regime or not to be sued? And that is really what it boils down to. People, from a rational point of view, from an economic point of view, all think the SEC is effectively, in their quest for jurisdiction, trying to push companies offshore. They may not want them to go offshore, they want jurisdiction, but the effect is very, very clear that the U.S. is losing thousands of jobs already as more and more companies find homes overseas. And it's becoming a big battleground. But this is all in a backdrop of two other cases that are starting to get closer to the finish line. Now, it's going to be a while for the first one, the Grayscale case, to get to the finish line because it just started a few months ago. But we haven't heard any news over the last month, but that could be a very, very big deal towards the Bitcoin ETF question. The other case that is getting close to the finish line is the Ripple case. And I am not an expert on this. You can read or watch videos from John Deaton who will go into this in great detail. But with these cases as a backdrop, it's extremely likely that the courts are going to give some, if not enough, clarity on the future direction of crypto. It could very well be negative. It could be that the SEC is going to be able to push companies offshore, or it could be positive that the SEC is going to have their wings clipped. Either way, it bears watching, because the fact of the matter is most good companies want some sort of regulation, and right now there's no clarity. The point that I've made repeatedly on this, and I will make it every time the subject comes up, is that there's a disingenuous claim that keeps getting made, which is simple. The SEC says the rules that we currently have can work, except for the fact that they can't. All of the SEC disclosures for the tokens themselves are based upon corporate issuers. Many tokens don't have a corporate issuer. They're based upon financials. Most tokens have no financials. They're based upon disclosure of the rights of equity or bondholders, and most tokens have economic models that have nothing to do with equities or bonds. In other words, they're not debt, and they're not participation in profit. So as a result, there is no real way for issuer type disclosures to work. On the trading side, there are many reasons why it's difficult. It's purely multi-currency, bearer instrument, the ability to have on-demand settlement, the lack of a need for a custodian slash clearing agent, et cetera, et cetera, et cetera. In short, as Hester Pierce has often said, there's a need for new rules in order for the SEC to regulate. This is going to come to a head, maybe not this week, maybe not even this month, but certainly over the next upcoming quarter or two, we should see more that happens. But what is coming to a head over the next month is going to be something on the macro side. So first, we have a Federal Reserve decision next week. In all likelihood, that decision is going to be to raise rates 25 basis points and then signal, but not totally, signal a pause. And they will, of course, give themselves outs if they see inflation accelerating to be able to raise rates again. And of course, to give themselves an out if things crater. But this is in a backdrop of an ever increasingly unstable macro environment. We've seen First Republic Bank go absolutely hammered this week, and there's rumors of multiple stresses inside the banking system, many of which caused by a cratering corporate real estate market. And why corporate real estate would crater is pretty obvious. We talked about that before. We have occupancy rates in the major cities below 50%, and we have leases that are going to expire, and that's a bad news for people who have corporate real estate as collateral. So there's lots of stresses in the banking system. The original stress in the banking system is almost certain to cause less lending, which is going to cause a drag on the economy. And so people like Mike McGlone, who Scott Melker and he and I talked on Macro Monday this Monday on the Wolf of Wall Street's YouTube channel. You can go back and watch Mike's entire rationale. But his rationale is fairly doom-oriented. He believes we are seeing the end of a great reset. We are seeing us tipping into recession, and that's going to bring down all risk assets. And while I agree that there's a fairly large likelihood of risk assets facing significant headwinds, I think the Federal Reserve will blink. I also think that the debt crisis that's going on, the debt ceiling crisis, could provide yet another rationale for this to resolve. Now, will it resolve with the Republicans caving to Biden, just giving him giving him the debt ceiling increase? That would be very bullish for risk assets because it proves that there's absolutely no restraint on spending. Will it resolve with a default and a showdown a stalemate that goes on for a while? That will be very bad for all U.S. based assets, certainly bad for the dollar, probably bad for everything, even the long term. That should be wildly bullish for Bitcoin as an alternative. Or will it resolve by the Biden administration doing something that has heretofore been unthinkable, which is minting the platinum coin? Now, to understand whether that's going to happen, watch to see if Janet Yellen does in fact step down this month. There were rumors a while back that in May she might be thinking of stepping down. I don't know if those are true. For all I know, she's going to serve out the rest of the 2 years of the administration. I don't know. I have zero information about that. But what I do know is that if they mint the platinum coin, while it doesn't have any real impact upon anything from a macro point of view, symbolically, it's a very big deal. It is a big deal that there's no restraint to money printing in the United States, and I suspect that would trigger a massive rally in Bitcoin at least, and Bitcoin will generally drag crypto in its wake. So it's worth understanding that that is the backdrop for what's going on. So, to sum up, what have we seen? We've seen basically a month of us being in a trading range. The trading range we're in, to remind everybody, is the same range, that 28-ish to 32-ish range that we stayed in for over a month and a half on the way down last year post-Luna and before the final two cataclysms, the Celsius and bankruptcy, which was the last in the wave of bankruptcies of the lenders, and then, of course, the FTX induced trading range, which wasn't really a trading range. It was a tradable bottom as people puked assets because they thought that the entire crypto ecosystem was unraveling. Well, it's not unraveling. There are volumes are starting to creep back up in the crypto market. New exchanges are starting to emerge. Binance is certainly a very large one, and rumors of Binance's demise, of course, trigger people to worry about the crypto market, but that doesn't actually look like it's happening. So I guess we'll see. The fact of the matter is the Bitcoin use case is certainly here to stay. The other big thing that's happened over the last month is we've seen it play out in Ethereum after post-Shanghai upgrade exactly as I said it would, which is to say that once you could stake Ethereum with no risk that you had indeterminate hold on those assets, they were locked up, more and more people are willing to stake. So the Ethereum network is growing. At the same time, the Bitcoin network is growing for different use cases. I was listening to a podcast earlier this week from Bitcoin Maxis talking about Bitcoin and basically saying it's the only real base layer for the internet. And that may very well be true from a value perspective. But Ethereum, as a base layer for other entrepreneurs to build upon, is still gaining traction and the network is getting stronger. And so those are fundamentally good for crypto in general. We'll see how everything plays out over the coming weeks, but for now, we are still in a trading range. My biggest advice to everyone would be, as I've said multiple times, I am long-term extremely bullish. Do not use a lot of leverage and understand that there will be significant volatility along the way. Will we break out of this range to the downside? I doubt it, but it's possible if something really bad happens. And will we break out of this range to the upside? I think it will, but we're going to need to clear some of the stuff that we've just talked about. In any case, stay safe out there, and I'll see you soon from Miami.